Good afternoon, or good evening to my friends across the pond. Good evening, Ian.
Evening,
Sunday,
George.
Sunday, February 5. Should be a great room today. So before we get into it, as has become our custom, I like to review 3 dates in history, this date in history. I'm adopting a sports theme today. Quite a coincidence, actually. And Ian, I know you don't count yourself amongst the biggest baseball fans, but I think this will even resonate with you. In 1895, Babe Ruth, who's considered to be one of the greatest baseball players of all time, was born in Baltimore, Maryland. In 1927, he hit 60 home runs, which was a record that stood for 34 years until Roger Maris broke it, subsequently further broken. But Babe Ruth born in 1895, and it's kind of ironic. In 1934, Hank Aaron, who broke Babe Ruth's career home run record in 1974, I remember watching as a kid. I was a big baseball fan. Hank Aaron, who broke Ruth's record who hit 714 home runs in 1974, he broke Ruth's record. It's just kind of funny. Aaron and Ruth born on the same day. And then finally, a more recent event that for all the football fans that are out there, in 2017, 6 years ago, February 5th, 2017, Tom Brady, then of the New England Patriots, who, by the way, just retired this week for the second and final time, led the Patriots to overcome a 25-point deficit in defeating the Atlanta Falcons. That was an unprecedented comeback, and so it was one of the greatest comebacks ever. So in any event, so today it's all sports. Enough of that, Ian. They didn't come here to hear about sports, but for my notification, if nobody else is, I like looking this stuff up. So Ian,
Uh, I was
Ian,
going to say it
go.
was a great game, the Brady game, and thanks to anybody that's listening rather than watching the Pro Bowl at the moment. So,
Oh, there you go. Ian, is American football taking up much of a following in London?
oh yeah, big
Yeah.
following. There's a number of games that are played here every year, and compared to when I started watching American football in the mid 1980s, it's now a big it's a general interest sport in the UK.
Well, maybe you should. Maybe in this space, if you feel like it, or another one, we could talk about European football. So, I
European soccer.
yeah, I don't know. I wish they had more scoring, but that's just me. At any rate, 2023 has started off with quite a bang in markets. I've not gotten markets right. I've been on the wrong side of markets. We'll get into your views as well. You and I have had a chat and
Yeah.
have a pretty good idea what you're saying. And so, Ian, I will post up. I'll yield the floor to yourself, and as you're speaking, I will throw up some of your recent tweets, so you can rely upon them to outline your thoughts. We have a very good room. I can see some of the usual suspects in the crowd, and so it should be a lively conversation. So, for those of you that don't know Ian, he's become made his Twitter debut earlier this year, I believe, and really you're quite, your rooms have been quite well received, Ian. Thoughtful.
Thank you.
You're not a bomb thrower, and so when Ian speaks, most people tend to listen. So, without further ado, Ian, let me yield the floor to yourself, and I will post some of your tweets up in the nest as you're speaking. So, take it away, Ian.
Thanks very much indeed, George. And so, what George and I have agreed is that I'll just give an outline of what we're saying to our institutional clients at the current time. And then we'll take the conversation where George and where the rest of the room want to go. Like George, I've also been too cautious over the last few months, but I still believe from an asset allocation perspective, this is very much too soon to be bullish. I think this is still a bear market rally. And I think the interesting thing is that it is not a risk on rally. It's an everything rally. And that tells you that it's about liquidity. It's not about anything else. And so I know I saw Michael is on the line. So I'm sure that we'll hear from him. But my question is, how long can that liquidity expansion that has fueled this rally over the last few months be sustained? And where has it come from? Because when you look at the underlying situation, we are still looking at a world that has seen, and it's a global phenomenon, the broadest, fastest, and largest rate rising cycle since 1980. I love the intro music. That's just the way it is. That's the way it is. And when you get that kind of rate rise environment, the probability of recession globally goes to close to 100%. A lot of our models are putting to that recession risk through this year. And we would still hold that. We still think that there's a real chance of global economic slowdown, and you're seeing it in a number of the pieces of data. Yeah, there's counter data points in the short term, but what we would want to say is, first of all, beware about the difference between real and nominal. There isn't an immaculate disinflation. Lower prices do come with a cost, and that cost is actually that the sales of a lot of the corporates that have been holding up these earnings numbers are going to start coming down, and it's going to be a double whammy because the pricing power is going to be diminished, and also the volumes are going to be coming down because of the lagged effects of those interest rates. And when you take those weaker sales against costs that will remain high, because although wage inflation is starting to moderate very slowly, it's still rising quite rapidly compared to history. That's an environment where margins get absolutely crunched. So we are still very comfortable forecasting that global earnings will fall between 15 and 20%, over the course of this year to their lowest point. They might start bouncing by the end of the year, but probably not. I would think would be my guess that might last into 2024, and that some countries or some areas like the Eurozone, you might see that being even more acute because of the operational gearing, the cyclicality that you see in those economies. I'm still very cautious about the UK and the Eurozone. The other thing that we're very cautious about is financial stress. We still see a world where the Fed actually only pivots not because inflation comes down, but because they get forced to pivot. They get forced to pivot because unemployment goes up, and that unemployment goes up because financial stress has continued to rise. So we are looking at things like the bank lending survey from the ECB last week. Tomorrow, we have the senior loan officers survey coming out from the Federal Reserve. We are seeing stress around the financial institutions. We're seeing stress in the financial markets. We've seen some really quite acute destruction of wealth over the last 12 months. We're calling this quantitative destruction, the shift from QE, which provided almost limitless zero interest rate liquidity, to a world of QT and interest rate rises, we believe will lead to this quantitative destruction, the systematic unwinding of the institutions and the structures that were built and thrived in a world of zero rates and low inflation. We've seen it with crypto, we've seen it with buy now, pay later, we've seen it with the LDI crisis in the UK. We believe that is going to impact two key areas in 2023, global housing, and it's also going to move into the corporate credit markets. The key thing, however, is that the main reason why I still remained very cautious and defensive, George, is that I just don't think equities are cheap. I don't think they're cheap in absolute terms, particularly not after this rally. And that's pretty much around the world. So yes, I'd even include the Eurozone in that. And they are definitely not cheap against bonds. So in the models that we use, and I think George will post up one of those that looks at detrended bond equity yield ratios. So what are the yield on bonds relative to the yield on equities? If you detrend that over the last 10 years and look at that relative to the last 100 years of data, you'll find that this is potentially a once-in-a-generation opportunity to switch out of equities and back into bonds. So, add into that things like the Shiller PE, which at 31 times gives you a projected return of between 3% and 5% over the next decade on an annualized basis. And you can see why we are still very, very cautious indeed. So we would want to be, maximum underweight equities. I think that is still a very, obviously a very strong view to take, maximum underweight equities. And maximum overweight in cash is what we're recommending to our clients. And, overweight bonds and underweight credit in this environment. And within equities, we'd want to play the much more defensive parts of the market, things like healthcare, utilities, food producers, grocery, drugstore type stocks. And we want to avoid the operationally leveraged areas, which would include energy and financials. So, George, that's the kind of summary that we would provide our institutional clients. And then, normally we've got a couple of hundred charts that we can go through to try and explain, why we've got these ridiculous views.
Right, that's terrific, Ian, and we're going to spare our friends in the room death by PowerPoint. So, Ian, I started to put some up. They're not in any particular order, but if you take a look here, if you scroll over to the second chart, all the way over on the right, there's one where it's entitled "Valuations Always Matter," and you've got a graph here of subsequent 10-year return. It's using the Shiller PE, and maybe speak to this. What is it you like about this? What do you say to those who take issue with the Shiller PE is giving false signals? So I hope you can see the chart. It's your tweet from a few days ago. It's the tweet from February 2nd.
Yeah, no, that's great, George. Thank you very much. Yeah, so I clearly there are question marks about the Shiller PE. The pushback that I would say is that any of these fundamental valuation metrics have got their issues, but what I found is the Shiller PE actually maps very nicely onto a number of other variables. So the Federal Reserve Board produced their own measure of something called Tobin's Q, which is just the cost of capital for equity versus the cost of replacement capital. And it maps onto this almost perfectly. Also, the share of equities in household portfolios, maps onto it very nicely as well. So you've got a whole range of variables that map onto this and would point to the fact that we are still at very extended valuations, and bearing in mind that that share of equities is actually a volume. It also tells you that investors haven't really sold down their positions yet either, which typically we do see in bear markets, George. I think the key thing is that for all the theoretical weakness of the Shiller PE, as a strategist, I tend to be more of an empiricist. And the other chart that we put out on that day, on the February the 2nd, just shows you the very nice straight line that if you do monthly returns over the last 70 years, there's a very nice inverse relationship between where the Shiller PE today and 10-year returns further out. And that's the basis that we've got. I think bear in mind that the Shiller PE does reflect also the degree to which you've got profitability in the economy. You could probably overlay profit margins and profits to a degree as well on this chart, George. So there's fundamentals behind it, and it does just reminds us that if you have got to get 31 times current trend earnings to justify where we are today. So yeah, I just think it's relatively simple, but it's been a pretty good indicator of where we might go in the next decade.
Right. So yes, Ian, to your point, if you look in the nest, you'll see I just threw it up. It's the graph over on the far left. I believe this is the one you're referring to, from February 2nd. It says just a reality check on buying the S&P, and you've got here the Shiller PE against the 10-year returns. Is this the chart that you were talking about?
Yes, no,
So
that
sorry,
is the one that I'm talking about. So
right. So that's what you're talking about being in Paris. And then if you scroll over one to the right, Ian, this is what you were talking about now. This was a tweet you put up on the 3rd. You were talking about the bond equity yield ratio. Is this the one that you were talking about? How is it?
no,
I believe this is.
that's a slightly different story,
Got it.
which
Okay.
is, there's, the Shiller PE is just looking at the absolute valuation for equities.
Right.
But one of the things that I mentioned in the overview was this chart from February the 3rd.
Yeah, Ian. Let me interrupt you. I think I maybe I had to make myself clear. That's the one I'm referring to. If you look at,
Yeah,
not the newest chart, but the next one over, from the 3rd,
yeah.
it shows the. I believe this
I'm
is
on
right. It's
my phone. I don't seem to be able to see it the same. Ah, yeah, I found it now. Yeah,
okay. I think that's
that's
when
the
you're
one.
talking
Yeah.
about where. Yeah. So maybe you could speak to this, please. It's quite eye
Yeah,
opening.
so I find that, we should remember that equities are determined not just by the performance of earnings and other macro factors, but also what the alternative assets are that you can access. And so the way that I've always done this for the last 20 or 30 years is looking at bond yields divided by equities yields, whether that's a dividend yield or an earnings yield, doesn't really matter when you take the relatives. And then the z-score is just normalizing it. So how volatile have bonds and equities been over the last 3 years, 5 years, or 10 years? The longer that you want to look back and the longer that you want to look forward, it makes more sense to use a long detrending. So what we've done is taken, the 10-year, today's divergence between equity yields and bond yields, and a higher number here is equities being expensive, bonds being cheap. A lower number here is bonds being expensive and equities being cheap. And what this speaks to is that the rapid rise in equities that we've seen over the last decade, driving down their dividend and earnings yield, at the same time that we've now seen bond yields rise very dramatically in the last 12 months. So, relative to the 10-year trend, they have gone up substantially. The combination of those two things has produced as big a divergence between bonds and equities that you've seen at any time since just before the tech bubble. So almost a 20-year, this is why I'm saying this is a once in a generation opportunity. And when we've seen these things in the past, be that 1980, 1968, the Nifty 50 type period, and 1929, these were periods where you saw a couple of things. First of all, you saw quite often multiple down years for equities. And secondly, the scale of the losses that you saw for equities relative to bonds over the next 3 to 5 years averaged between 25% and 75%, George. So, what this shows me and says to me is either bond yields have got a long way to come back down, or equity yields have got a long way to go up, i.e. equity prices have got a long way to come down. So, we just think that equities versus bonds are still very expensive indeed. And that would also fit, I think, with the fourth chart that you've put on about the equity risk premium. If I could just move us to that very quickly, which I think was from the 19th of the 1st.
Yes. The 19th of January. Yes.
Because that this is a more sophisticated way, and if people object to using the Shiller PE, then there are about 3,000 different objections to using equity risk premia, because there's actually 27 different ways of calculating it according to one Fed paper. We use 9 different methods, and we take the median of those 9 different methods, and this is what this chart shows you. But the simple thing here is that the equity risk premium says equities are expensive when the number is lower. and they are cheaper when the number goes up. Look at those grey bars, recessions. The equity risk premium always goes up in recession, George. Where's it gone in the last 3 months? Down.
Right. Well, that's so
the end story, basically.
Right. So let's just hold that.
Yeah.
I want to come on to the economy and earnings estimates. I just want you to elaborate for everyone who wants to understand what you're talking about. Let's go back to the one where you've got the equity,
bond equity.
the switch chart, bond equity. Okay. Just so people understand the yield ratio. Maybe just explain to people what is the equity yield ratio. It's the inverse of the PE, I presume, the way you use it here. Is that right?
Well, actually, this is based on the dividend yield because it's it's easier to get dividend history going back to 1910 than and more reliable than earnings yields.
But when you you mentioned there's so many different ways of calculating this, and some would say, well, gee, the dividend yield is a little bit anomalous because companies more than ever are repurchasing shares. So if you look at the total return, if you took an earnings yield. So, but we said there's 27 different ways to do this, and you do 9 of them. When you tinker with it, do you still come up with the same conclusion?
Yeah, we can use pretty much any form of earnings, any kind of dividend models that you like to use. I still find that equities are not discounting recession and are actually discounting a continuation of Goldilocks. And Goldilocks in terms of profit margins, Goldilocks in terms of earnings growth. And we just think that is incredibly optimistic in a world where central banks are determined to keep monetary policy tight enough to really kill inflation. And that's it just seems to me to be anomalous that we are quite so markets are still very optimistic about this, partly because I think they lost so much money last year. I think there are a lot of investors that just desperately hoping that it's very unusual to get a double down year, and therefore let's bet against it.
Okay, well, let's stay with it. Let's go to the economy and earnings. That plays into equities. Candidly, the economy has held up better than I thought it would have, and probably can be said for a lot of observers. Nevertheless, earnings estimates have been falling. It's very clear that we are certainly in a bear market for earnings. So could you talk a little bit, you mentioned a few minutes ago about how you're quite comfortable in looking at a 15 to 20% decline in earnings this year. How changes the margin over the last 2-3 months? How's that been working for you? Been resolute in your view? Have things come in better than expected, worse than expected? Like changes the margin.
So I think things are basically coming down in line with expectations. If you look at the 2023 earnings expectations, they have come down from 250 roughly, I think, to 223. And the trouble is our expectation is that by the end of this year they could well be at 200, maybe lower than that. But what's happened is that the 2024 numbers have come down by similar amounts, but they are still 10% higher than the 2023 figures. So your 12-month forward earnings expectations haven't really come down very far. So that's one of the illusions that's out there in the market. But historically, if you take the median of the last 5 US recessions, the earnings decline was about 20%. So a 20% decline in earnings should not surprise anybody. It sounds a really bad number, but if you believe there's going to be a recession, that's the number. That's your base. That should be your baseline forecast, in our opinion.
Ian, maybe let's just go with that a little bit further. So, because you're a student of financial history, and when you detrend earnings, and you look at the, I say trying to control.
I can tell you where. I can see where you're going, John.
This is like,
you don't want to do that.
Ian, I start the sentence, you can finish it. You know where this is going.
You don't want to.
So, So it's like my grandfather should never ask a question you don't already know the answer to. So just to review the catechism here on this. So speak to, not all cycles are equal. History rhymes, doesn't repeat itself. The extent to which, excuse me while I stuff some words in your mouth here.
That's okay.
but,
I'm used to that.
but
30 years of knowing you, George.
exactly. So, okay. All right. So sorry. So let me try the Columbo routine instead. So, Mr. Harn, I look at this graph here and I see the earnings line. I see the trend. Gee, it's kind of like, I don't know. Does this mean earnings could fall more than usual in this recession or not? Like, talk to me about, you said wouldn't be surprised. I
Yeah.
mean, in other words, what's the likelihood that earnings wind up being not so bad or even worse than possibly? What would
I
you
think
say?
we would still argue that the probability is that they will turn out worse rather than better. I think there is a very high level of comfort, in markets and complacency. One might even go as far as to say that about earnings expectations because of the nominal growth that we have seen. We still believe that, you are going to see, you never see a problem with earnings, as inflation goes up. You can always price goods higher and your earnings hold up well. It's when you actually see economic growth slow and inflation slow that sales come down and margins just get absolutely crashed. Operational gearing, so the relationship between sales and profits, has become twice as volatile over the last 15 years than it was in the 15 years before that. So operational leverage has increased across the economy, the US economy. And you talked about detrending those. We're starting about 25 to 30%, depending on whether you're looking at the US or global equities, above trend. Every recession, every bear market sees earnings finish below trend, George. That's the reason why I still feel that we've got, unless policymakers have a change of heart and they decide to extend this cycle and we just push this cycle out for another 2 years, 3 years, etc., and we kick the can down the line. If there is going to be a day of reckoning, then that reckoning comes in profits. And if ironically, for all the discussion about leveling up in the UK or about getting greater equality in the US that President Biden was talking about, the way to do that is have a recession. Recessions hurt corporates more than they hurt households, and that's so profits. And if you want to use some of the macro variables that we look at for this earnings story, first of all, let's look at the corporates themselves. The CEO confidence survey is at close to record lows. They are telling you things are bad. Secondly, global trade and global earnings have been positively related, very closely related, going back to the 1970s. And the latest trade data that one of the short-term indicators that we look at is Frankfurt air freight. That's down more than 20% year on year, George. And finally, the other great indicator, US manufacturing new orders. And, last week, those were absolutely horrendous. So, I know the services numbers picked up all right on the Tuesday, on Friday. But, the bottom line is that it's actually been the manufacturing numbers that have always driven earnings, because economic activity is actually driven in its volatility much more by the manufacturing side than the services side, even though the services side is larger. So yeah, I'm still very comfortable with that analysis.
Right. Another question related to that. So things don't turn on a dime or sixpence, whatever you guys call it. There are leads and lags. And so we saw last year, interest rates go up, and probably the most rapid increase in interest rates in history, or something like approaching that. But bond yields have come off a bit, but short rates haven't. They've come for a tiny bit. But so rates are still very much higher than they were 12, 18 months ago. The oil price shot up from depressed levels. It's come off a bit. And the dollar went up significantly, and it's come off a bit. So maybe for starting with rates, when you think about, and I hope Michael Howell will weigh on this one when we get into the Q&A. How do you think about the leads and lags of these things? For instance, housing is in a bad way right now because, even though mortgage rates have come off, there's a lag in terms of how quickly the increase in rates impacts the economy. So how do you think about the leads and lags on all these variables, be it housing, be it the dollar, being at the oil price?
So I think the people, I think the markets, two things. First of all, the markets, have in many ways become more immediate, with the rise in passive investing. We've seen from things like some of the FedEx results we've had over the last year or so. If you can see the disaster coming. The active managers, know it's coming, but we still get the stock down 20, 30% on the day when you get the rubbish earnings numbers. So more passive markets provides more opportunity for macro investing, and we've got a chart on that. But what's the leads and the lags? Economists always say monetary policy acts with long and variable lags, and that is definitely true. I think that one should recognize that in the last couple of years, we've been able to absorb some of the shocks of higher interest rates, particularly in the last year, by running down those savings. Savings reached a record low in terms of rates of the flow savings rate. There's still probably a stock of saving that is still available, but the only way that you can sustain the type of retail sales growth at the time when real incomes have been squeezed back to 2019 levels is by either running down your savings or by borrowing more. And I think consumers have assumed that they can trade through this because interest rates will come down and the Fed will bail them out. And that's a dangerous assumption. And I think we're going to see delinquency rates, well, we're already starting to see those start to rise. They're very low levels. We're already starting to see insolvency start to rise from very low levels. In the UK, actually, we've now seen insolvencies rise over 50% in the last 12 months. I think we're still in the early phases of those interest rate effects feeding through. As for oil prices, George, the work that we've done in the past suggests that oil prices have to go up for a good 6 months, on a continuous basis and stay up rising. And it's not until you get almost 3 years down the line. So it's actually almost an 18-month change, and 18 months later, do you get the maximum impact in terms of the negative. So the improvement that we're seeing in things like the European gas prices, the oil prices, those are going to feed into 2024, 2025 recovery, as opposed to 2023 recovery, in my view.
Got it. So, Ian, one of the charts you mentioned, it's about, it's 4 or 5 in. You and I spoke about before the call. It's from Jan 26. You just sort of touched on it. You were talking before about the macro and the trade-off between macro beta and stock alpha. Could you speak a little bit to this chart? I find this is fascinating. It means, if I read it correctly, it means there's less to be done in terms of stock picking, more about just getting the macro
and
right.
I think
Go ahead.
That's so that chart that you've kindly put up for us again, George, from the 26th to the 1st. Yeah, so what we do is to see where the high level of correlation is within the markets. And so this is looking at equity prices, how they link together, and we do something called a principal component analysis, and we take the first 3 common factors and basically say, well, those are going to be, everything's moving together, so that's going to be a macro factor. And what is left is therefore idiosyncratic risk and what people might call alpha in terms of stock picking. And it's one of multiple ways of trying to calculate this kind of measure. But I think you obviously are an outstanding single stock investor that's had decades of experience of doing this, and I think you would probably agree. It's got harder rather than easier, as regulatory changes have come through, the growth of passive investing. There's a whole range of factors. The rise of mutual funds, that have meant that alpha in markets looks as though it's been squeezed out. So, our conclusion is that the markets have become much more driven by these common factors, by the macro factors. The surprise is that people say, "Oh, well, it's beta, therefore I can't beat the market," but actually you can trade that beta. And what we're surprised at is that still a lot of institutional investors spend 90% of their research budget on trying to capture that declining alpha, and only 10% of their research budgets trying to capture the 70% that is coming from the macro beta side.
Terrific. One more question, Ian. Then I see Michael Howell is joining us. It's terrific. Actually, I'll ask Michael Howell the same question as yourself. The question is, Ian, from where you sit, you look geographically at the States, Europe, China, Japan, etc. Do you notice any disparate trends, or is it anything noteworthy on a geographical basis?
I think clearly we're looking at the scope for the China recovery to come through. I think something that feeds into one of Michael's points would be that we've seen some liquidity expansion. I think one reason why I'm nervous about that liquidity expansion is that I think it comes largely from Japan and to a lesser degree from China. And our analysis is that the Chinese authorities don't want to see that liquidity expansion continue, and there's a limit as to how far the Chinese recovery is going to go, therefore, and how long it can be sustained. It relies very much on domestic savings coming down. And what we've seen around the world is when you do the reopening, it is basically a domestic consumer phenomenon. It's not going to be a driver of global growth in the way that I think some of the markets are currently pricing it. So I think China may have got a bit ahead of itself. I think Europe's a long way ahead of itself because Europe is cyclical. If you don't get a global cyclical recovery, Europe's now massively overpriced. And I actually think that the US is the place that has now got, it's still expensive, but in the world of the ugly, it may outperform on a relative basis.
That's terrific, Ian. Okay, so let's our good mutual friend Mr. Howell is here, no stranger to these rooms. Good to see you, Michael. How are you?
Hi, George. I'm pretty well, thanks.
Excellent.
How are you doing?
Excellent. So maybe you've been banging the drum about the change in liquidity conditions globally, and I think in particular citing what's been coming out of the Far East. So I was just asking Ian about geographical differences. So maybe since you look at the world slightly differently from Ian, you're looking at it through the prism of liquidity. And I remember, Michael, when I first met you many years ago, I get pissed off. You didn't care about valuations or anything. It's always how much money is there in the world and where's it going to go. So maybe, Michael, start off with your sort of China angle and and how you see disparate trends in liquidity in economies. And so take it away, Michael. Good to see you.
Okay, yeah. Let me start off. I mean, I was only intending to be a listener here, so I'm going to try and extemporize. So it may sound rather jumbled, but let me sort of continue. I mean, basically, we were on the dark side, and we've moved very, very much into, if you like, a positive view of markets, and that was triggered basically by two things. One of those was what happened in the UK in September in the gilt debacle. Many of you may remember the horror show in the British sovereign debt market. And that triggered a change among central banks globally. The one thing that central banks want to defend is not necessarily inflation or unemployment. It's the integrity of their sovereign debt markets. And just think, had what happened in the British gilt market happened to the US Treasury market, we'd all be toast by now. So this was a big, big wake-up call. What you've seen in the US since then is the Federal Reserve is deliberately targeting US bank reserves. Make no mistake about that. You look at how much bank reserves have flatlined pretty much since that time. The Federal Reserve is eager that those bank reserves do not fall much below $3 trillion. And I got in for a lot of stick on Twitter and on other podcasts. I mean, I don't know what those guys, the Italian guy was pretty rude about what I was saying. The Italian guy, one of these, Blockworks, was very rude about what we were doing. But actually, time has borne that out. What I've been saying is that there's a big change in terms of central bank sentiment. Doesn't mean to say that QT is not going to headline QT is not going to happen, because basically they're going to allow US treasuries to roll off the balance sheet. But just consider in detail what Governor Waller said about two weeks ago. And what they're trying to do is to fudge the numbers. They're trying to have their cake and eat it. And what you're going to see in the US is the reverse repo run off quite fast. That will allow them to shrink the balance sheet cosmetically, but bank reserves will stay up. In other words, what that means in dollars and cents is that basically Fed liquidity conditions basically have stopped going down now. QT is effectively dead. And liquidity in the US is going to start to pick up, I would suspect, over the course of the next few weeks. The second thing to say in terms of that comment is to ask everyone's got to ask a question and that of themselves, and that is: does the Federal Reserve and the US Treasury want to create a recession this year when you've got a significant likely step up in the war in Europe going on? And that's, I think, a big question. I don't think they do. So what's the point in creating recession now? So that's a point to ponder when you're thinking about policy. The second thing is what's happening in China. Japan, we know, is goosing the markets with liquidity. They're going to continue. The next BOJ head is likely to be a fairly benign, soft choice, and they'll continue this policy. But China is the big change. And a lot of commentators who, in our view, look at the wrong things, but in a way, thankfully, they do, have been saying that China is not easing. There's no evidence. Just quite the contrary. China has basically put 3 trillion yuan renminbi into their financial markets in the last 2 months. That's about $450 billion. That compares, or that is at a rate which is 3 to 3.5 times the total amount they put into their markets in the previous 2 years. So that's what the change is. China is going for it. They've got to get their economy moving. And pretty much ever since they've done that, look at what commodity prices have done. Look at what cyclical stocks have done. Our measures, we do a lot of nowcasting work on economies, and our nowcasting of the world economy has almost gone vertical since the beginning of November, since they started this policy. So what you're seeing is a significant change. And we've entitled our recent research, "When the facts change, we change our mind," and that's what's going on. So basically, what I would say is, in essence, we don't look at PE multiples. I've never found them particularly useful in terms of a macro view. We tend to look at the markets. The markets are telling us things have changed. I'd single out 2 indicators to people to consider. One is crypto. Crypto has got nothing behind it. It's a pure liquidity phenomenon. But liquidity is up and crypto is up big time. And if liquidity continues to go up, so will crypto. The second thing is an indicator that I always call the Stan Druckenmiller index. Druckenmiller always used to say that the best economist is the internals of the stock market. And he used to have a chart which looked at cyclicals versus defensives. And if you look at cyclicals versus defensives and overlay that on the economy, it's almost 1 for 1. And what you've seen is a big breakout in terms of that cyclicals defensive, and it's tracking exactly our indicators of where the world economy is going. So it looks as if things have changed quite quite noticeably. And in terms of where we're positioned, we're negative on bonds. We're upbeat on equities. We like gold. We like crypto. We like corporate debt. We like technology, emerging markets, underweight defensive, and underweight US.
So let's stay with that. So we've got sort of, if I may, the liquidity view from Michael, and Ian more sort of the fundamental profits and earnings view, and I guess they're somewhat related. But so I'll go to stay with you, Michael, and then back to Ian. So let's say they're going for all the reasons you outlined. By the way, just sidebar. You mentioned you're expecting an escalation in the war. Is that correct?
Yeah. Well, if you start exporting tanks from every part of the world into Ukraine, I always thought a tank was an offensive weapon, not a defensive weapon.
There you go.
Maybe I'm wrong.
Okay, sorry. I need some more caffeine. Fine. So, let's say that's all right, and then I suppose it speaks to the what happens to inflation, interest rates, and so on and so forth. Because one of the longstanding fears has been that if they ease too quickly, the inflation thing picks up again. Blah 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 blah. So what are your thoughts about the inflation picture, Michael?
Well, I think in the short term, I think inflation is coming down quite fast. I think that's right. I think it's going to be volatile. It's not going to be dead overnight. So I think we're looking at I wouldn't be surprised to see a slightly higher level of trend inflation over the long term, but it to be a lot more volatile. I think that's would be my view. I think this year it's coming down quite significantly, and I think that would be fair. I think the point which is I suppose uppermost in my mind is is Jay Powell a Volcker? Is he trying to do a Volcker? I don't think this year. I think that if you're going to do a Volcker, probably the best time is 2 or 3 years time, not now. It's better to get a little bit of inflation into the system, try and devalue some of this debt, and if you're going to if you are going to try and get rid of the debt problem, why do it this year? Do it, 3, 4, 5 years down the road, pretty much as the US did in the 70s. You don't want to do it. You don't do it in 74, 75. You do it in 80, 81. That sort of time frame. You get a little bit of inflation, you get a headwind with a backwind with some inflation. Devalue the debt and then start to hike rates and squeeze people. But I don't think there's any merit doing it now. And I would say that, if you look at it politically in the US, third year of a presidential term, pretty good time normally for the markets. War in Europe, why create a recession? All the data that we've seen in the earnings season, as far as I can tell, I don't look at this stuff very closely, looks as if you're looking at some sort of bottoming out going on. So I don't know. As you can tell, I'm a lot more upbeat. Doesn't mean to say I think equities are going to have a stunning year. That's not my view. We think that the big markets, equities and bonds, pretty much range bound through the year. But unlike 2022, you're going to see some really strong performances from certain sectors. And we're upbeat on cyclicals and have been. We think tech is probably going to do okay. It's really a liquidity phenomenon. And defensives, that's what a lot of people have got. They'd like it underperformed.
So, George, can I come back in on that one? Because,
of course, Ian, go for it.
So, Michael, one of the other charts that, you talk about the Stan Druckenmiller chart about cyclicals versus defensives and linking to economic activity. But one of the charts we use with our clients is a long run chart of inflation. And if you look at inflation and look at cyclicals versus defensives, you find a phrase that we've described as always and everywhere, inflation is a cyclical phenomenon. So if you think that inflation is coming down this year on a cyclical basis, then the likelihood is that cyclicals underperform. Because you need that pricing power. So, it's really just a cross check. And I suppose the other question that I have, which I tried to hint at, is absolutely agree with you. What we're seeing at the moment is that there has been this liquidity expansion. We always talk about the dollar as being the best real-time liquidity indicator. Obviously, yours is going to be better, but if you're looking at the market, and again, as you say, the internals of the market work well, then how long can that liquidity expansion last? And I think that's the thing that I worry about, which is how long can the BOJ pump in $750 billion of liquidity, and how long is the PBOC willing to do so? And I think in relation to that, what we've seen in the Fed is really quite modest indeed, and the TGA.
Well, I think to answer that question, it's something that we're not forecasting whether liquidity is going to go up in 6 months' time or 12 months' time. Our point is that what we're doing is we're monitoring liquidity. Liquidity is a leading indicator, and that's almost all you need to know. If they've got the taps on, markets will go up. If the taps turn off, markets will come down. We tend to use liquidity to understand the markets, and the markets to understand the economy. So it's a sort of different sequencing, I guess.
Yeah, so I suppose we'd really just say that's more the dynamic asset allocation side, where liquidity sentiment drive things, and I suppose where we're trying to do is trying to guess where the next 6 months after that might be going from a range of indicators, which would obviously also include the liquidity side, and so looking for the strategic asset allocation 12 to 18 months, and then the longer term asset allocation as well.
Right. So we're in this. So let's go back to the Fed this past week. I'm not really a very good Fed watcher, but Michael, since you very carefully watch all the monetary stuff, and you said not a time necessarily for Powell to do a Volcker. What did you? I think many observers were very surprised. I was certainly when he got up and didn't push back against this extraordinary easing in financial conditions that we've seen in recent months. In fact, you'd have the numbers better than I, but I think they're already back to where they were a year ago or something like that. I mean, this is hardly suggestive someone wants to be Paul Volcker 2.0, to your point, but what was your takeaway from what he said last week?
Well, I think it's difficult to say much after listening to any of these governors, and I've always learned best thing to do is to look at what they're doing rather than what they're saying. But the actions of the Federal Reserve, in terms of what they're doing in the markets, their own interventions, would suggest that they're on a very different agenda to the headline QT agenda, and you can see that if you just look at the amount of debt that's rolling off the balance sheet. It's nothing like the trend they once suggested. And if you look more closely, not so much at the headline QT, but if you look at the effective QT, it's effectively gone sideways to slightly higher. And then these numbers are going to be slightly out of date because they're weekly numbers. But I think in the last 3 months, the Federal Reserve balance sheet shrank by maybe $280, $300 billion. But the Federal Reserve managed to inject about $60 billion net into the system. I mean, these are decent amounts of money. I mean, they're not huge, as Ian points out, but they're significant. And the fact is that we've got a Federal Reserve and we've got many central banks globally that are now turning towards easing or inflecting upwards, let's say, beginnings of easing rather than tightening. And it's inflections that markets, as we know, inflections are the key point. And that's where we are.
Yeah, you mentioned Michael earlier the reserve repo, and maybe just touch on briefly the TGA account, because I know that's a big swing variable as well. You just speak to the TGA account for a second, Michael, and what that's meant.
Okay, right. What you've got in terms of the Federal Reserve balance sheet is you've got one element that everyone tends to focus on, which is the asset side of the balance sheet, which is effectively dominated by the roll-off of treasuries. Okay, and that's what is the headline QT that people figure on. But that does not measure the liquidity that's going into the system, okay? Because there are offsets or other factors that come into it, which you've got to look at the liability side of the balance sheet to understand. One of those is the reverse repo account, which is basically a tool that the Federal Reserve invented to absorb some of the huge cash deposits that people found themselves with after the COVID giveaways. And that sucked up liquidity at the front end of the market to try and preserve the integrity of short-term rates in a rate hiking environment. The second is the TGA, which I'll come on to. And the third is the losses that the Federal Reserve is making at the operating level because it's paying out more interest than it's now receiving coupon on the Treasury holdings. Those factors can either subtract or add to liquidity. The losses add to liquidity. The TGA and the reverse repo tend to vary, but a bigger reverse repo is a detraction, and a bigger Treasury General account, which is the Treasury's account at the Federal Reserve, is also a detraction. Now, what's upcoming is the debt ceiling. And the debt ceiling will mean that there can be no more debt issuance. I mean, as it goes, stands for a reason, but it means that they can't issue debt. So what will happen is there'll be various manipulations. The fortunate part for the Biden administration is that this is the heavy tax paying season. So the TGA normally goes up in this time of the year. So what will happen is that the TGA will go up. It will detract from liquidity in the short term. So February may be a bad month, but then they'll run down the TGA to levels. I mean, it's currently 500 billion. It'll probably be run down, I suspect, to levels of about 100 billion or thereabouts. But they'll try other means of actually raising money. But that is directly a 400 billion injection into the system, without any question. I don't know if that answers your question.
No, it certainly does. It certainly does. So before we go to Emma will be next, and then Nostra. Ian, let me ask you a question. So let's say we get this, this Michael's, this fill-up in liquidity we're getting here, which is boosting markets. Let's say this continues on, and looking at valuations, how do you bridge? Let's say Michael's right, and Michael and markets are, not wildly higher, but up. They certainly don't go down from here. Ian, looking at where valuations are in the market, if this in fact was a bottom, a bottom, I don't know, a bottom, what? And you're looking at S&P earnings, I don't know, $200 this year, roundabout, whatever. Wouldn't this make this one of the most expensive, highly valued bottoms in the history of markets?
Oh, yeah, it would, George. And I think that's the point here, which is that, and I think that's the other pushback to Michael that I would just perhaps take issue with about the inflection points, because historically the inflection points when the Fed has pivoted downwards have tended, apart from 1995, to be bad news. The median decline when the Fed has cut rates, after we've seen the peak in the effective federal funds rate, has been something like 28% down relative to bonds. Sometimes it's taken 3 years to get to the bottom. Sometimes it's taken 3 weeks, as it did in 1987. It's unless, as I say, we're seeing central banks that just want to extend this cycle, but how does that fit with the narrative that they want to get inflation down? The probability is that something is already broken or is breaking. We're seeing the problems in the housing market. We're seeing the problems in some of these other markets. I find it very difficult to see, George, how we could sustain these kind of valuations without having a massive expansion of liquidity, another QE level of, and I'm not sure, Michael, that you're really expecting that kind of expansion of liquidity. So you'd either need to see, big liquidity expansion, in my view, or you'd need to see a big fiscal expansion being met by accommodating monetary policy to sustain this.
Yeah, I'll go to Emma one second. But Michael, Howell, one question for you: What do interest rates and bond yields do in the world you're thinking about, Michael?
I think the corporate debt market looks attractive, particularly some of the around the investment grade area. I think there's some attractions for sure. I think that in terms of the government market, the U.S. Treasury market, take the 10-year yield. I wouldn't expect it to be much different, 12 months from now than where we are. So I think it ranges sideways. I mean, in many ways, I think the market environment looks like, to me, 2001, 2002, parche the fact that, clearly in the middle of that, we got the, catastrophic 9/11 events. But, looking through that, I think that if you look at the behavior of the markets, I think it's going to be, it's going to unfold in that way, where you actually saw the Treasury market kind of flatlining through that period. It gave you decent returns, but nothing overwhelming. But you got some really big performances coming out of corporate debt, and then you started to see equities pick up, admittedly with something of a lag. But that's the template that I would tend to think we're following.
But Michael, don't those bank lending surveys that we saw out the ECB last week, and the senior loan officer surveys out of the Federal Reserve, they just scare me witless, because historically they've been really good indicators of credit spreads and credit defaults, and they're saying that that this is just going to be a train wreck over the next 12 months.
I must say I look closely at those. I've never found them particularly prescient. But I mean, I'm not. You may well have done. I don't know, but I've never found anything in them. I think that
I'll put a
I tend to
chart
look
up on.
a lot.
I'll put a chart up and in a moment, and you can have a look.
Sure.
Yeah,
I tend to look at the internals of the fixed income markets a lot. I mean, that's putting my Salomon Brothers hat on. I mean, that's what I was always taught. And if you look at the internals of the Treasury market, it's telling you that the economy is due to bottom in America around May of this year, and that would make sense if you take. There was a thing on Twitter I put up the other day, which I got from Capital Group, which showed on average the stock market picks up 6 months before a bottom in the economy. And if that's the case, then those things are kind of lining up quite well.
So let's turn to some other questions from the audience. I'd like to do Emma first, then Nostra, and then Illinois. Emma, good to see you. What's on your mind?
Hi, George. Thanks for bringing me up. So I just had a question for Michael. You mentioned you would expect the U.S. 10-year Treasury to be roughly flat at the end of the year. How does the BOJ factor into your assessment there?
Well, thanks, Emma. I mean, I wasn't really factoring the BOJ into that. I think that, if you take what's happening in Japan, I mean, who knows what's happening in Japan? Even they aren't too sure. I think I think my reading of it is that what you've got is an attempt to run a persistently loose policy, while yes, persistently loose policy, with the caveat that what's really driving this in many ways is maybe what is latently driving the US policy, which is to preserve the integrity of the treasury markets. And I think that the move that the BOJ made back in when was it, December, was not a monetary policy easing so much as actually a way of trying to make the markets, the treasury market, the JGB market, more liquid, because I mean liquidity had just dried up in that market. I suspect that you will see yields going up a bit in Japan, but I don't think necessarily hugely. And I think they're going to use QE as they did before. But the thing with the Japanese, as we know, is that there's a lot of moral suasion going on with the institutions, and it's quite possible they will force institutions to go back into the JGB. Actually, technically, or arithmetically, it's actually probably to their advantage now anyway. But that will take money out of treasuries. So I think that there's upside risks on treasuries. I think the rate expectations will come down. But the point that we keep making repeatedly, ad nauseum is that the huge problem in the treasury markets is the term premium. I mean, it's just massively negative, and that can almost only go up from here, which means you've kind of got a two-way or three-way pull on the bond market, which is why I'm not particularly upbeat on treasuries generally.
Got it. So, good question, Aaron. Thanks for that. Let's move on to Nostra, and then Illinois, and then Gnostic. Nostra, good to see you.
Hey, George. Thanks for having me up. Michael, I had a question also about the about U.S. Treasuries. You did say you were bearish bonds, but at the same time, you said you expect it to be flat. So my question is, I mean, we all know this debt ceiling is just political theater, but with the Fed running a net operating loss and going from remitting profits to the Treasury to now running massive losses that eventually have to be paid by the Treasury. So my overall question is, when do you think the U.S. sovereign debt comes into question?
It's a very good question. I wish I had an answer to that. I think, look, at the end of the day, the US is the cleanest shirt in the laundry, and that's, I think, the way we've got to think about it. I mean, things aren't good with the fiscal balances in the US, but I tell you, there are damn sight worse everywhere else. So I think from that perspective, the treasury market may continue to or may maintain its integrity for longer than we think. But the whole issue that central banks or treasurers have got to face in the next 5 to 10 years, which I'm sure Ian would endorse, is that the fiscal arithmetic just doesn't work. And at the end of the day, Japan is the canary in the coal mine here. What we've seen in Japan is going to transmit to every Western economy, and that means not just QE, disinflation, and whatever else. It also means yield curve control. And actually, after all, maybe what these central banks are doing now in different guises is different forms of yield curve control.
Great, thanks for that. Great question. Okay, let's now go to Illinois, and then Gnostic, and then KFEB. Illinois.
Hey, George. Thanks for having me up. Ian, Michael, great space. Michael, I think you raised a really good point here. I think if everybody was taking a look at where we were this time last year, and people had told us rates would be 4.5%, and unemployment would be 3.4%, and monetary conditions, financial conditions would be easing, I think a lot of us would have been pretty surprised. I certainly would have been. My question is, getting back to this whole debt situation, debt to GDP is roughly over 100%, even on a net basis. If the monetary effect on financial conditions of 100 basis point rate hike is X, what is the offsetting, fiscal effect from, increasing fiscal stimulus by, 1 percentage point of GDP? Is it 0.1x? Is it 0.5x? Or is it, approaching, the same effect of the monetary impact?
Well, I mean, I'm not maybe the best person to ask. I mean, I must say, although I've got a PhD in economics, I've long lost faith in economics as a predictor. I don't do any sort of fiscal arithmetic. I tend to focus entirely on sort of fund flows and liquidity. So maybe Ian, maybe it can answer the question.
I'm not sure about that either. And again, but I think the one thing I would say is that bear in mind that the fiscal tends to be more immediate than the monetary, and I think that that's one thing to bear in mind. And if anything, what we're seeing is a rundown of those fiscal stimulus measures in a number of countries around the world, as far as I understand it. And the lagged effects of the monetary side are still to come through. And I think I would just, the thing that I would just remind a few people is, when in the Illinois, in the way that you presented that argument, it sounds great, but it sounded as though you were talking about a world where we were back to normal. The S&P is still down 14% from its highs. we are still talking about a bond market that had losses the like of which you haven't seen in a century. This has been a violent, screw where central banks have completely torn up the idea that they were providing any kind of support for bondholders. And at some point they will end up having to pay for that. That the bond risk premium has risen, and I do think that this balance between monetary and fiscal policy, I do think is a bit overplayed here. But what we do know is that monetary policy tightening has been extreme, and the fiscal easing is beginning to moderate. But as Michael said, there's some military spending, but that just means I want to buy defense companies. It doesn't. I'm not sure that it really does anything about overall global growth or anything like that. Sorry, I'm not sure that really answers your question, though, Illinois.
Illinois, you ask a excellent question, deceptively complicated. So thanks for the question.
George, just
yeah.
if I can, I mean, I don't
Please.
want to hog this because it's not my show, but what? Just to ask a question, what are the technicians saying? Well, what about your mate Dennis Gartman? What's his view at the moment?
The chartists are all they're all bulled up now because they're all momentum animals, and
okay,
and they're
but he's not really, is he?
No, he's not. But I mean, I wouldn't cite him so much. But those who are maybe even more closely following these things, and I've been watching, they're all, as the markets have gone up, they're all become increasingly positive. So, but it tends to go with a lag. But no, I mean, things like market breadth, and as you rightly pointed out, the internals of the market, the cyclicals against the defensives and others, it's generally been very positive. And so,
Belkin?
I've been caught out by this rally for sure.
Belkin, what's he saying?
Belkin is very. I'll send you something later. He's become positive as well. I'll give Michael credit. He turned positive a couple of months ago, so he's been sort of one step ahead of the rest. So my hat's off to him.
But isn't this the point, George? Which is that bear market rallies are always technical rallies and liquidity-driven rallies. Fundamental rallies get driven by earnings and multiples, and they're sustained by underlying economics. And I think this is the reason why, Michael, I'm so. I have a lot of sympathy with your view that this is a liquidity driven, because everything has gone up. Bonds have gone up and equities have gone up. That tells you this is about liquidity. But once that liquidity stops, then this stuff comes back down. And that's the reason why I'm still cautious.
And the $64,000 question is, whether that's next week or 6 months from now. I mean, a lot can happen. And bear market rallies, we talked about this a lot over the year. Bear market rallies are a feature, not a bug. I was reading. So yeah, I mean, look, we'll see. I mean, it's very, very compelling arguments on all sides here. Let's move along. I'd like to go to Gnostic and then KFed. Gnostic, good to see you. What's on your mind?
Oh, massive confusion, which is being presented here. Michael, Ian, wow, what a great presentation for both sides of the market. And you basically present me with a confused mind, which I've been confused about for some time now, and great explanations for both sides of it, which subsequently only increases my confusion, which usually means there's something going on that is outside of the realm of either of the fundamental areas that both Michael and Ian are talking about. And so there's something else going on that we just don't have a good handle for it. And I certainly don't myself. Just as a little side note, anecdotal note here, before I get into the question that I had, I was talking to a senior bank person in a bank in Canada just this week, who was saying to me that one of the things that they're seeing is a whole bunch of people, particularly older people, switching to GICs out of the standard investments that they've been doing. And this is one of the issues I'm trying to wrap my head around about the possible lack of liquidity in the marketplace. And Michael or Ian, the question that sort of surrounded me with what you were saying, Michael, your microphone's open at the moment. One of the things that raised while you were doing things is, it sounds like what you're saying is there's a leak in the liquidity somewhere, which nobody's putting their finger on. And that's being replaced at the moment. When it withdraws, that leak in liquidity is going to increase. And I wonder if that leak isn't people going to US currency as a method of protection at the moment, and how you would answer that one as to a seek for safety rather than investment return, which is distorting things in the marketplace.
Again, Michael may be a better person to answer, because you look at the flows more closely than I do, Michael. Are you seeing that in terms of the dollar? And then I'll come back and answer. From my side.
I mean, the first thing is that the flows of money are moving out of the dollar. I don't think that's going to be. I mean, I think one's got to temper that to say that I still believe that the dollar is in a longer term uptrend, but I think that what we're seeing is a correction in the dollar. And if you look at capital flows, they've been moving out of the dollar in the last last 2 or 3 months on our numbers. A lot of money is moving into emerging markets. That's for sure. And as we know, cyclicals. So I think all those boxes are ticked. So yeah, I mean, I think the other thing on the liquidity front, which is something that reinforced our views, and is looking at market liquidity in the treasury market. We do our own daily calculations of the depth of the US Treasury market, and that index bottomed. I mean, if it runs between, let me give you a scale, 0 to 100, that index dropped kind of like a stone, really, to a low point in September of about 10 on the index at the height of the British gilt crisis. It's rebounded strongly. It's currently just over 50. So that gives you some idea about how depth has increased in the treasury market over that period. And that's only because funds have flowed in to the market, courtesy partly of the Fed. And if you look at Bloomberg do a similar index, I'm not sure what's in theirs, but they do a similar thing, and it shows almost exactly the same feature. So I think that's true. I think the other thing I'd say is that we've been upbeat, but this has not been an easy market to make money out of. I mean, our funds, although they made money in November, December, lost money in January, and that was because January was a really tricky month to trade. We were negative on Europe going into the month. We had a lot of money in Asia. And Asia did okay, but it didn't do as well as Europe. And then by the end of the month, China sold off. So we ended up losing money, bizarrely, although we got an upbeat view. So these are tricky markets to trade.
Yeah, I think that's very true, and I think that the other thing is that what you said, Michael, about I think the point that Yellen stepped in actively to increase liquidity in the treasury market. I think that there's been a real question mark about the liquidity around high quality debt. In the last 3 months that central banks are trying to resolve, because partly because they have screwed the bond market so badly in the previous 12 months. Oddly enough, people have said we don't want to play that game anymore. Nosti, I think I would still, I think your point is absolutely brilliant. That if there's so much confusion, something must be going on that none of us have quite got a handle on, and we'll find out later. So I think there's something in that background, but I do also believe that we're underestimating the role of Japanese liquidity here. $750 billion. The EC, the BOJ has stepped in to try and hold that 50 basis point line. With Amamiya-san, that I'm sure some people have seen the Japanese press are saying that Amamiya-san has been approached about being the next head of the BOJ, which would be a continuity candidate. That's how long can they carry on pumping in that much amount of money? As long as they carry on doing that, these markets go higher. But it's a very, very fragile market recovery if it's based purely on Japanese liquidity.
Thanks, Saverio. Okay, let's move on. We're going to do KFAB and then Peter. KFAB, the floor is yours.
Thanks, George. I actually had a question, one each for Ian and Michael. Ian, yours. So my working thesis is that we're particularly in the G7 experience kind of a classic business cycle where inventories are very high at the kind of wholesale and finished good level, and that the long financialization and the long nap of moderation and business cycles in the last 40 years in the West in particular, we're not used to this anymore. And the UK has kind of been on the forefront of that, and that's they're beginning that liquidation process already, and you see the implications of what that means to their economy. And Germany and France, for example, haven't even really begun that process. So what do you think about that thesis as far as more of a classic bullwhip effect centric business cycle where the main economic forces in Europe and obviously the US might be facing that kind of kind of throwback 70s style recession?
I'd even take you back further than that, KFAB, which is to go back to the 60s, where we saw, GDP, I think, go from 10% to zero 4 times in a decade. And it's that kind of volatility that then does tend to undermine valuations. It undermines valuation in bond markets and undermines valuations in equity markets. I have a lot of sympathy with that view and that bullwhip effect type argument. And I think you're absolutely right in terms of suggesting that the European economies haven't really started to see that play out yet. I think the one angle that I would add to this, and I think I tried to refer to it earlier, is that actually the greater operational leverage that we've got in the economy now makes that much more profound in terms of its impact on the earnings side. But I think the key thing that we've been trying to get across to people is the idea that the only reason why margins look so good on average is because the margins of the largest cap stocks are hiding the squeeze on margins in small and mid caps. And what's happened is that large companies have outsourced both their capex and their labor to the small and mid cap companies. And that's where you're going to see these inventory cycles played out most rapidly. It's why we use the NFIB data extensively, and we worry about what we see in the NFIB data, where you're starting to see those inventory numbers changing and the earnings numbers coming down more aggressively. And the only question we have is how many will we actually then start to see vendor financing as the large caps try to keep their supply chains in one piece. And suddenly the cash flow of these large cap companies that you think have got great cash flow and strong margins, that suddenly just disappears, as rapidly as you could possibly imagine, as they try and keep the supply chains afloat. And maybe that does extend the cycle, but it makes it a world that I think is very dangerous. So I have a lot of sympathy with your view. Is the bottom line, and I think you will see. Our models are still suggesting that Eurozone economic activity down, another 5% plus, and Eurozone earnings down 30% this year.
Ian, just FYI, a few minutes ago, I did put up, if you look in the next 2 charts, one showing your tweet from the other day, small cap access to liquidity is a tweet from today, actually, and then also the credit, the senior loan officer thing you mentioned earlier. So that's reference to support the point you made. Yeah, KFAB, you had a question, another question, I think, for Michael Howell.
Yeah, certainly a biased question and directional, given my viewpoint. But last time I spoke with Michael on one of your spaces, George, I asked him the same question. So I'm going to see if his point of view has shifted. Given that I have a recessionary bias, would a severe global recession, have you changed your mind in that maybe that filter addressing the term premium issue, meaning that there's 2 ways for the term premium to reconcile itself, is my understanding, and severe global recession would be another filter for that could address that issue.
Yeah, hi KFAB. I can't remember what my answer was last time, so this is a fresh attempt. Look, I think that I suppose what I would say is that I think that we've seen most of the correction in the world economy already. I mean, we've come down on some of the indexes that we're looking at, and we do we look at confirming indicators from things like business sentiment and shipping activity and whatever. A lot of our indexes have come down from sort of on a 0-100 scale from sort of circa 80 at the peak to levels now of about 40. So there's already been some big corrections, and we still think that the world economy may well soften a little bit more over the next couple of months. But I think that our view is that most of it's kind of already behind us in that regard. I think the point about the term premia, which you're absolutely right to say that the term premia would be affected if people think there's a recession, a deeper recession coming, for sure. But I think the other things that are distorting the term premia are just this fact about there's a general shortage of collateral in the system, and that's telling us a lot more about financial fragility than maybe economic fragility, and that's why I think the yield curve is actually such a biased indicator. I wrote a paper, an academic paper, a few years ago in the Journal of the Journal of Fixed Income, which was basically saying, a statistical analysis saying, what does the yield curve slope really tell us? And actually, the answer was not much. I mean, it's as wrong as often as it's right, and you've got to start looking very closely at the particular yield curve spread, the maturity spread, to actually pinpoint when recessions occur, and that maturity spread flips around from recession to recession. So it's kind of a very hard gauge. If term premia are so distorted right now, and given the nature of the fixed income markets, it's almost definitely telling us that the yield curve is hugely distorted on the downside. And this big negative yield curve spread that people are pointing to and saying it supports big recession, I think is wrong, because I think it's purely distorted. So on all those scores, I would still say that maybe we're through most of that downturn.
Great. Thanks for the question. Ilana, you had a follow-up?
Hey, George. Yeah. About 10 or 15 minutes ago, you guys were talking about degree of confusion and uncertainty in the market. You got into it a little bit with no stick, and I have a feeling that just based off of the price action last week, I think there's a lot of smart money out there that kind of feels bamboozled by the past week on a certain level. My question is, just given the degree of disagreement, should the VIX be at 18 right now? And also, before anybody says, well, that's just short-term options, you can get implied volatilities as low as 18% going out 2 years on leaps in both EEM and SPY. Does anybody have a view on where implied volatility should be right now, or is it trading too cheap?
Yeah, Illinois, you asked a great question, and honestly, I studied it a lot lately. I don't pretend to know, and smart people that I pay attention to just have said it doesn't. The market's just been, because of these daily options, the VIX doesn't mean what it used to, and it's lost its relevance as an indicator. That's my takeaway from it, but that's an uninformed opinion. I'm just outsourcing to others that I've read. So I think you can just drive yourself batty. There's no information content in the VIX. I don't know. I don't know if Ian, Mike, or anybody else on stage has an opinion about that.
I'll throw in. I think it's just a function of that excess. The high level of liquidity that Michael's talking about at the current time, George. And I think it does. I think we will find that it does have information content. And what does a low VIX always tell you? Is that a sign of good news ahead or bad news ahead? the thing that always happens is that everybody gets bloody complacent, when the VIX is at below 20, and then it suddenly spikes up and everybody gets absolutely killed. So I think, for me, it's an indicator that there is the liquidity that Michael's talking about. It has been a liquidity rally, and that's validated by the dollar weakening and the VIX being lower. And it's something that I'm very concerned about, because as soon as somebody stops turning that spigot off, then it all goes south in a big way.
I think, George, if I could make a
Please.
I mean, one would be just to come back to something. I think it was Peter who was asking the question about the dollar and weaponization. FYI, sort of an unashamed plug. I wrote a book a few years ago about weaponization of the dollar called Capital Wars, which was basically about the whole, if you like, interlocking of horns between America and China, and all this liquidity stuff as well. So if you're interested, it's around. It was published about 3 or 4 years ago. Capital Wars. The other thing to say is that I endorse your point about VIX. I think that maybe there is a distortion in there. So look at alternative gauges. Look at the MOVE index, which may not be perfect, but it's not a bad index of volatility in the bond markets. And volatility in the bond markets is coming down. Now, the point about fixed income is that, which I've spent a lot of my time looking at. If you look at the fixed income markets, they're behaving absolutely on cue. Everything that you would expect to see in fixed income is happening. Right down to the fact that this is the stage of the cycle when volatility drops. If you get a drop in volatility, corporate debt tends to outperform. It is. All these things kind of are lining up. And they're lining up as well with the idea that the economy basically bottoms in the next 3 or 4 months. Again, I mean, that seems to be spot on. The other thing which I'd throw in is that, in inverted commas here, the world's most important central bank share price seems to be going up last time I looked. And that is JP Morgan. The role of JP Morgan in financing, particularly in the tri-party repo system, where it's basically backstopped by the Fed, but it does a huge amount of lending into repos. The fact that bank's share price continued to go up and has broken out and was a very early mover is probably endorsing the fact that this is a liquidity-driven rally. They are the engine.
Got it. Makes sense. All right. Let's go to Chris. Chris, please unmute yourself. We got you.
This is Chris Galizio. I ran a growth fund at Fidelity. Grew it from 20 million to 7 billion. Started to realize that markets don't make sense anymore. You guys still are all talking about how people are doing certain things. The point of the movie is 2 things. First of all, when interest rates go negative, all out.
Hang on, Chris. Hang on. Please, if you have a question, that's great, but please don't plug the movie. I'm sorry. I'm sure it's a good movie, but
I don't care with the movie. Let me make the point. When interest rates go negative, all assets are worth infinite. It's just mathematical. The value of $1 paid annually is 1 divided by interest rate, right? So if interest rates are 10%, it's $10. When interest rates go to 1%, it's $100. When interest rates go negative, it's infinite. In the movie, we say when interest rates go negative, all assets are worth infinite. My coffee is worth infinite. My desk is worth infinite. My chalkboards are worth infinite. Does that make sense? And of course, it doesn't make sense, because who would ever buy a bond with a negative yield from a country that's monetizing its debt? That's my point number 1. Point number 2: the ecosystem of capitalism has changed. Right? When you remove risk from a system, you change the ecosystem. Right? So if you remove the lions from the savannah, the gazelle population explodes. Passive investing. But then they're competing for scarce water resources and die off. In our movie, we say the biggest line in the movie, and is correct when you remove risk from an ecosystem, it changes the ecosystem. Is basically the main point of that. But what you guys aren't understanding is it's not people anymore. It's quants and passive. 80% of the markets, more than 80% of the market is quants and passive. The stock market no longer predicts anything. It's just a policy tool of the Fed, right? It just reacts to Fed news. When the Fed cuts interest rates, stocks go up. When the dollar falls, stocks go up. What people don't realize is that it's not people in markets anymore. The ecosystem changes. That's the only point I wanted to make.
Thanks for that.
Good
Appreciate it.
point.
Well, you know,
Yeah, I know
I think that we're still in the stage where we don't know whether that's true, Chris. And you know, so my narrative would be that you know the challenge to that will be when we see the Fed start to cut, because and whether they start to cut because they are responding to lower inflation, or whether they're doing what they nearly always have to do, which is that they're cutting because they don't get a choice because something's blowing up in the marketplaces, and you know that you know we'll see the rates coming down and asset prices coming down at the same time, or certainly risk asset prices coming down at the same time. So you know I think. But you're absolutely right, which is that because of that increased passiveness, I think there is a real opportunity here, because you know if you are able to anticipate some of the things that are going to happen, you know whether that is in Michael's world where liquidity has taken off again, and you know in my world where it starts to get squeezed back down again. Then you know, there are real opportunities, because you know once the bad stuff hits the fan and we see you know a bad set of earnings numbers for a particular company, you know then yeah their share price drops not just 3%, but it drops 10% or 15% as the algos kick in behind the real money.
Yeah, Ian, can I ask you a question? I want to ask you and Michael a question. Michael Howell. None of us are spring chickens. We've been doing this for a while. Going to the changes that the questioner was asking, how have you evolved? How have you changed the way you approach markets, analyze markets, Ian, in the decades you've been doing this? So first Ian and then Michael.
So you know the thing that strikes me, George, is that for all the talk about changing structures of markets, and for all the talk about the changing structure of the economy from the manufacturing to the consumer, you know what we find is that the number of our models, macro to market models, that still work like they have done for the last 20, 30, 40, 50, 100 years. And, you know, that's what we're looking for. We're looking for the things that are still staying the same, and then trying to say, well, why are the anomalies able to be sustained, and how long can they be sustained for? And at the moment, the high level of bond yields relative to what's happening in the real economy is a real anomaly, you know, and the chart that I put up about term premia and you know just highlights that there's an anomaly there, you know that will get resolved. So I stick to the things that have worked well across multiple cycles, across multiple political regimes, liquidity regimes, and economic regimes, and you know there are some of those that still work, like the relationship between earnings and trade globally. It's worked since the 1970s. Let's stick to it. And so you know that's. But maybe I'm becoming a dinosaur, George.
All of us. Michael Howell, any thoughts from you, and how's your approach changed, if at all, or do you sort of echo Ian's thoughts that you know try to stay with what's worked, tried and true?
Well, I mean, you know, all the liquidity models that we use and we build, or that were built when I was at Salomon Brothers between 86 and 92. They haven't changed at all in terms of what we do. Exactly the same framework. The only thing that's changed is different countries have basically come and gone. Japan was a big player in the 80s and 90s. It's kind of not that important really now. China has come from nowhere to be huge. And so, you know, the two main central banks worldwide are the Fed and the PBOC. And that's where we spend most of our time looking. But, you know, others are there. But it's not really the models that have changed. It's the geographical importance, I think.
Yeah. And just one follow on, and then we're going to have Michael Kramer ask a question. But just one follow up on that, both for go to Ian first and then Michael. Ian, does this market remind you, either because it's similarity or difference, to past extended bull markets? I mean, one of the charts I was struck by, Ian, in your presentation that you shared with me was the duration of this bull run. You were basically, saying set aside COVID because that was sort of a one-off. They fixed it, but this run from 2009 or thereabouts up 500% or whatever the numbers are. How does this market differ? This bull run differ from others, and or is it similar? And how does it inform you, Ian?
I think that we're, a number of the indicators that I'm looking at suggest that, we're in that, 99, 2000 type period where, in many ways the pandemic played the 97 LTCM type role that re-injected the extension of the cycle from 98, to 2000, and took us to relative valuations between equities and bonds that are quite extreme. We've seen some unwinding of that, so I think we're halfway through 2001, maybe even into 9/11 type period. But we're a long way from 2003, and I think that was one of the things that I felt about all the talk about FTX being the Lehman Brothers moment for crypto. For me, it was just the beginning of the process, which was much more like New Century when we saw them go bust. In 2007, and it was another 18 months before you really hit the bottom. So I think we're still in the first third of this bear market as far as I'm concerned, George.
Ian, I think in your research, not just for the audience, you had what, a 3,000, 3,200 S&P sort of
and
number?
I'm still very comfortable with that. I think that penciling in a round number like 200 for the earnings and putting that on the average of the last 10 to 15 years forward PEs, which is 16 times, gives you a number of 3,200. I know Michael Kantrovitz has got the same kind of number as well, so we're not alone on that. But I wouldn't be surprised if at some point this year we trade through on the downside to that number. So I'm still very comfortable with that number at the current time.
Awesome. And Michael Howell, yourself, I don't know if you have any follow-on thoughts.
Sorry, George. What? I didn't get the question.
No. I mean, we spoke before. We both spoke to the point about how models. You try to stay with the models that have been consistent for you, and so I guess this has been excellent. Actually, the fact you such great minds reaching just different outcomes. I mean, as was it Yogi Berra once said, making predictions is difficult, especially about the future. So it's fascinating. You were two of the best investment minds I know, but coming out with different sort of conclusions. This is awesome. All right, before we close the room, I want to go to Michael Kramer, who has had a really good call. He's developed quite a profile on Twitter. Absolutely killed it throughout 2022. I gather 2023 is, like for Ian and myself, also a little bit more difficult. But Michael, you have any questions for Michael, Ian Harnett, any comments? And you'll be the last speaker.
Thanks, George. Thanks for giving me the opportunity, and thanks for the kind words. So I just had a quick question regarding liquidity, because as you know, I follow Fed balance sheet changes and reserve balances and ECB very closely as well. And those numbers have been coming down. And I know that the BOJ and the PBOC have been sort of increasing liquidity. I guess my one question is my understanding, which isn't, maybe as broad as yours, guys, when it comes to liquidity in the PBOC, how does that liquidity actually leave China? Because, it's a fixed currency and it's capital controls. They don't allow, money to leave. Is it through leverage? How does that what is the monetary sort of transmission mechanism there that pumping? Because there's clearly a relationship between PBOC, pumping up their balance sheet and let's say the move in Hong Kong. You can see it. It's a very clear correlation. But how does it leave that sort of closed currency system? And then the second point I wanted to make is I think you guys are leaving out something that's really important, which is the creation of 0 days till expiration and how that's really distorting the markets on a daily basis. I think that has really sort of created this almost casino-like atmosphere on a daily basis where the market goes down and, these guys come in and they start buying calls and you can see how how that's actually having an impact on the S&P 500 and the overall market. So I just wanted to get your thoughts and comments on that.
Okay, look, maybe that's one. If I take that first, maybe. I think if I didn't say it, I mean, I'm watching maybe the same movie that Chris is watching here. That liquidity and changing investor composition are kind of important elements in understanding the markets. As regards what's happening specifically in China, I mean, China doesn't have a closed capital account per se. I mean, officially, it may well have, but a lot of liquidity seeps out of China. But that's not really the point we were really making about China, and that is that China's economic footprint is huge, as we know. And I think that where I would say, in humility, where economists maybe misread China was that they first of all underestimated the extent of the reopening, and they were far too downbeat about China prospects on the reopening. And secondly, nobody factored in the fact that the PBOC would inject a lot of liquidity back into the system, or the scale of it. So I think that that's the surprise. The way that we tend to think of markets, and I'm going to sort of say something I denied earlier on, and that is that if you assume that we're in a PE and E world, I would say that the PE is determined in the US by the Federal Reserve, and I would say the E is determined in China, very crudely, by what happens by the PBOC. The PBOC has huge control over the Chinese economy, least we forget. And that's really what's driven commodity markets and cyclical stocks, or cyclical areas, particularly looking at the DAX in Germany, a lot higher. Now, the last thing I'd say is that I think that I don't believe there's a financial crisis bubbling. And one of the reasons is I think the Federal Reserve has got a lot greater handle on how the financial system is working right now than it did in prior years. Famous last words, of course. But one of the things the Federal Reserve is trying to do is to fix the bond market. Now, that may be no great surprise, but I think the point here is that the repo market, or those associated derivative type markets, are so important now for liquidity generation, and effectively the whole financial structure, that the only way the Federal Reserve can really control them properly is by operating directly in the bond market. And that's why I think that there's been this struggle or urgency to try and make sure the integrity of the bond market has been maintained. And that's why I would say, I'm not going to say there's a conspiracy going on here, but I would just say, don't take our data as gospel. Take a look at the Bloomberg US Treasury Market Liquidity Index, and you'll see that unless I'm mistaken, bottomed around the time of the UK gilt crisis and has moved up decisively since then. And I think that market liquidity has been a result of more funding liquidity being shoved into the system to try and do it. Now, maybe I'm wrong, but there's a narrative that seems to be working here.
Right.
Thanks for that, Michael. Really good question. Ian, you want to?
Yeah. So, Michael, my business partner David Bowers and I, have a phrase that we says things we know to be true but cannot prove. And I think that would be, how I feel about Chinese credit. So I think that for me, I posted a chart on Twitter in response to your question, which is I think that it actually works through the dollar. So I think that if the Chinese authorities create a lot of domestic liquidity, what they are generally trying to do is to encourage Chinese companies to use Chinese liquidity rather than dollar liquidity. And so they're reducing the ex ante demand for dollar from Chinese companies, and that creates an ex ante excess supply of dollars in the marketplace, which drives the dollar down when you have that pickup in Chinese credit impulse. So even though it's a closed system, because you are reducing the demand for global dollar demand by doing that, that's how I think it probably works. So that's my cat-candid explanation. But can I prove it? Absolutely not. But the chart looks pretty good.
Thanks. Great question, Michael. All right, so we're at the 2-hour mark.
try as I may. Room went longer than I thought. But that's because we have two fantastic speakers here. I want to thank Ian and Michael. This has been tremendous. It's a real treat to for us to hear your wisdom. Certainly starting off the year in a very interesting way. I'm sure there'll be plenty more surprises. I think we're going to see volatility. I think the market's going to confound all of us. But anyway, so again, thanks, Michael. This has been awesome. We'll do a room later this week. Any closing comments, Michael or Ian?
Well, I was just going to say, George, that the one thing that all of us have learned, and there are many very experienced and excellent investors on your spaces, is that the thing that markets always teach us is humility. And it's how can we manage to make it get it wrong this time is always the lesson that we learn. But we always try and make sure that we're on the right side of the 50%, and that's the key to the game here. But keep on learning every day. That's the thing we need to do. And thank you.
Markets never stand still.
Yeah.
Thank you for letting us share our thoughts.
Thanks, guys, and thanks, Ian. Thanks, I sort of approached your patch.
Ian, I've been served up a huge dose of humility myself this year, so amen. All right, listen, this has been great. We'll do this again before too long. Thanks, everyone. Good night. Take care.
Thanks very much,
George.
Good night. Cheers.
Bye.
Thanks, George.